What's going on? I'm calling this month the theme of sticky inflation. Have you heard that term? That's a new buzzword on Wall Street. Sticky inflation. Hi, and welcome. Welcome to Money Talks for Women. My name's Lynn Kitchen, and I am delighted to be with you on this May 1st market overview. You know, I have in my heart a passion for giving back the knowledge that I have gained over 5 decades of being a professional investor and a portfolio manager. 3.5 of those decades, I was an investment advisor, professional investment advisor, handling portfolios, and I am now truly just helping to educate and empower women to make better investment decisions over time so that they too can build wealth and create the kind of life that they want to live and have the impact that they want to have in their lives. And that takes good investments. That takes a good amount of skill and know-how. And so tonight I am creating what is my market overview, and I'm hoping that you will find some value in it because I really love making complex issues simple. And what I'm finding is that as we begin the month of May 2024, we have experienced a very, very strong stock market in the United States, a weak real estate market. We have had strong and high interest rates, high inflation, but we've had a promise from the Federal Reserve up till now that they were going to begin to lower interest rates in 2024, right? And because of that, the markets have been extremely excited because they see in the future that a lowering interest rates will be positive for the economy. However, wait just a minute. That doesn't appear to be what's really going on now. So let's just take a look and see if we can make some sense of all this and look to not only what's happening now, but what could be setting up to happen in the future. I'm so excited that you're here, and I'd love to have you put some feedback in the chats and the questions below so that I can make sure that I'm delivering to you what it is that's powerful and empowering. So what's going on? I'm calling this month the theme of sticky inflation. Have you heard that term? That's a new buzzword on Wall Street. Sticky inflation. Well, what does that mean? Sticky inflation. Well, really all it means is that the prices in our economy continuing to move higher. Inflation just does not want to come down. Those prices are sticking higher. They're sticking to the roof. They're not coming down the way that the Federal Reserve and all of the other market pundits thought that they would. So that's what we're calling sticky inflation. We're going to talk about that theme today. Let me share with you a few of my slides here. First of all, just a quick disclosure that this is for educational purposes only, and in no way at any mention at all of any individual investment. I am not recommending any kind of a personal action on your part. So this is for educational purposes only. And therefore, let's just proceed with the idea of sticky inflation as the market overview. Here it is, May 2024. We're in a sticky inflation economy. What is that? This is an AI-generated image that just simply shows what it feels like to be in the sticky inflation bubble. And that's where inflation just continues to move up in a bubble fashion, and it's sticky. It's impacting everything in our lives. It's persistent and pervasive. Those markets, I mean, the prices of everything just continues to go up, whether it's cars, the price of cars, the price of insuring cars, the price of housing, our mortgage rates are going up. Good heavens, the insurance on housing is going up. Uh, Food and all of the other commodity prices out there continuing to be going up, and that's called sticky inflation. It just doesn't seem to want to come down. Here's a chart about inflation just to kind of give you a perspective over the last 4 years. And we can see that back in 2022, we hit the high of inflation of just about 90%. And we have come down a lot since then, but we have stabled across really, but not coming down as far as this 2% inflation target, which is here at the bottom, that the Federal Reserve has a target that they want inflation to get down to this 2% line. Well, it's not cooperating. In fact, over here in 2024, we can see that the inflation rates are at a stubborn 3.6 or so percent. And they actually are sticking right there. They haven't come down. In fact, they may be trending up over time. And that's why we call this sticky inflation. Well, what does that mean to our environment? Is it true? Do we have where are we in the business cycle? Do you think that we are in something called disinflation? Let me ask you, how many of you put one in the chat? Do you think that we're in a disinflationary economy? Well, of course we're not, because if we were in disinflation, interest rates would be coming down dramatically, but they are not. So we are not in a disinflation economy. We're still in an inflationary economy. What about recession? Do you think that we're in recession? Well, no. Recession means that the GDP, or the gross domestic product, has been coming down, but that's not true either. The gross domestic product, or the amount of activity our business cycle is producing, is still going up. So we are not in a recession. What about deflation? Have you been hearing about that in the news recently? Are we in deflation after all? Well, actually, no. Deflation would occur again when interest rates would be trending down, as well as GDP going down. We don't have that either. Well, what about stagflation? Have you been hearing that in the news? With inflation continuing to move up, inflation moving up, that is true. Many people on the Wall Street have been coming out and saying, well, could be stagflation in the future. Watch out below. Are we in stagflation? Well, I believe, of course, we're not in stagflation yet either. Let's just take a look at what stagflation is once again. We covered this last month, but here we go. Yes, in stagflation, it does represent the fact that inflation is sticky, that it continues to move upward. But that's the only thing that's going on. If we were in stagflation, we would also see unemployment going up. Well, that is not happening either. We right now are in a very strong employment. So that is not happening. Also, in stagflation, we would be needing to see economic growth going down, and that is not happening either. In fact, economic growth has been strengthening. I have a little bit of a chart here that shows the last several quarters of the GDP, the gross domestic product, has actually been going up. The first quarter of 2024 is up 1.6%. So this is quarter by quarter. This quarter means that it is above, it may be above very small on this chart. The very middle is a 0. So it's above 0 at least, not by much. It's up 1.6%, but at least that's still up. It's not going down. So in other words, gross domestic product is still strong. We are definitely not in stagflation. Well, where are we? Where are we? Well, where we are is we're in Sticky inflation. Sticky inflation. That's where we are. That is where we are. We're in sticky inflation. It's a sticky, it's kind of like in between. In between. We're not really moving into a terrible economic contraction. We're not moving into a disinflation where interest rates are coming down. So it appears that the Federal Reserve, which has indicated that they're not going to be lowering interest rates anytime soon, but their good news is they're not going to be increasing interest rates either. What does that mean? It means the same higher interest rates for longer. Well, these interest rates being higher for longer might just be something that the economy can get used to, because it already is showing that it's still pretty darn strong. So it could be almost like a little Goldilocks moment. Sticky inflation is not that bad. Let's take a look at a chart that I found on inflation that I think is quite powerful. This is a chart that actually goes back to the 1990s. The 1990s, oops, sorry. The 1990s was a time in which we had the last inflation above the 3% normal range. So here we can see that the normal line, this red line right here, is about the 3% normal line of inflation over time. And back the last time that we had inflation above that was back in the 1990s. Well, I remember being an investment advisor back in the 1990s and dealing with that kind of inflation. But what happened was that from 1990 to now, we had a tremendous technology boom and a huge bull market with low interest rates. But here we have a blip on the horizon between 2020 and 2024, where interest rates have moved up to this 5% level where we are now. But it could be very true that it will just be a blip. In other words, a short-term possibility. This chart actually is called the purist's measure of inflation. I won't go into the math behind it, but it is one of the charts that I like to go to when we look at what is the real year over year pre-pandemic look at a pure measure of inflation. So this kind of gives you some historical indication over time that, interest rates may feel high right now, but it doesn't mean that that's going to be the way it is all the time and forever. This could easily just be a blip in time. Now, having said that, there's also room for speculation that things can be difficult. It doesn't mean that everything is rosy. I don't mean to imply that, but certainly we have the possibility of having interest rates higher for longer is not necessarily a bad and horrible thing. In other words, we very much have right now a period of strong earnings. So the underlying underpinnings of the market continues to be very strong in spite of the interest rates being higher for longer. We can look at the markets continuing to be strong over time, being led by the strong industry groups, the technology, AI, which I'm going to talk about in just a few minutes, and medical industries. And, here's a view of the current Standard & Poor's 500, which continues to certainly be very, very strong. It started its strength movement into October of 2023 and continues to move up, even with a short-term pullback recently, as it relates to a disappointment that those interest rates were not going to be coming down by the Federal Reserve. But actually, I believe that this could be a healthy pullback in the market and an opportunity for us to look for possible opportunities to buy quality companies when we see a little bit of a pullback in the markets. Nothing goes up forever, as you know. So this makes it important for us to take a look of the continued strength that we're seeing in the market as evidence and as an indication that everything is still moving forward in an expansionary methodology. So here's, we talk about the cycles of a business cycle and the expansionary possibility that we could still be in a long-term expansion, an extension of the bull market that we experienced from 2000 to 2020, right before the pandemic. And it could also be that this interest rate spike could be a short-term in nature, and we could get a continuation of the expansion of the business cycle. I wouldn't be surprised if that is the actual long-term case. Let's take a historic look. This is one of my favorite charts, a 100-year chart of the Standard & Poor's 500. And let's just take a look at the last time interest rates were this high. As I mentioned before, that would have been back in the 1990s. And here is the 1990s when the interest rates were as high as they are today. Well, take a look at this moment in time, and that just looks like a small blip, like a little tiny blip in the long-term progression of the markets moving in a 45-degree angle up. And let's take a look, notice what happened even after that little blip of higher interest rates in the 1990s. We had a tech boom that actually was the underpinnings for the move from 1990 all the way to 2024 of a total bull market trend. And I wouldn't be surprised out here in 2024, 2025, that we might also see another tech boom here that would also help to motor up the prices over time and even maybe ameliorate the impact of these higher interest rates that we're experiencing right now. So it could be, as I mentioned before, that this could be just a short-term impact, and yet we do have to be aware that there are other factors out there that are dangerous, that might be problems in the making. So we have to keep very, very aware and make sure that we understand that if those problems get larger quicker, that this scenario, this rosy scenario, we might have to call the trend in a different direction. But for now, we're not there yet. So for now, it's still looking quite rosy. In fact, we can look at the leadership in the Standard & Poor's 500, the 7 magnificent stocks that led the bull market in the last 10 years are still the leaders today. They continue to have strong earnings and continue to motor up the markets. So these kinds of trends are continuing, and that is important in a bullish trend for sure. We also have an awful lot of cash on the sideline, and that's a bullish trend. Of course, people are taking advantage of the high interest rates, putting their cash to work in CDs and in treasury bills so that they can lock in these current high 5% rates, and that are, high interest rates with low risk, and that's a prudent thing to do. But that qualifies as a lot of cash on the sideline, which again is a very bullish trend over time. Some of the difficult things that we continue to watch for, however, are the worsening geopolitical problems. Of course, we still have these 2 wars that we seem to be funding the government's, United States government continues to fund Ukraine and Gaza. We've got potential problems in the Red Sea, Iran, Lebanon. We have a tsunami immigration influx in the United States, very expensive. We also have a very tumultuous election year ahead and a lot of cross currents ahead. And of course, something new now, campus riots, not just in the United States, but worldwide. So a lot of geopolitical problems on the horizon. In addition, we have this continuous, difficult headwind of high debt, high government debt, high corporate debt, high personal debt, and of course, the United States is broke. Our sovereign bond rating is falling, and the high interest rates for longer is going to mean that the government debt will get even more expensive to afford. And so these are headwinds against the increase of the economic cycle ahead. But in addition, those reasons are an opportunity. No matter what, there are always new opportunities happening, and gold seems to be one of them. The price of gold making new highs, and certainly looks like a brand new bull market, at least in my opinion, of the trend of gold, which could be a good place of diversification for a portfolio for the long run that will help as a hedge against inflation, as certainly a hedge against this sticky inflation. And what do we do? What do we do now in this time of sticky inflation? Well, it's a high priority that we continue with a safety first attitude in our portfolios. We look at making sure that the cash portion of our portfolios are invested in taking advantage of the higher interest rates right now, as I mentioned before, investing in treasury bonds and CDs at this time to take advantage of the 5%, 5.5% interest rates. And also making sure that we stay in higher quality assets. It's a great time to prune any lower quality assets that you may have in your portfolios, and certainly be prepared to buy on the dips in the market. If we should have a 10% correction in the market or so, maybe even 15%, that would be healthy, but it's also an opportunity to buy high quality, but make sure that we stay in the highest quality that we can find. We also might be looking at gold as a hedge against this sticky inflation. We definitely want to continue to pay off debts, especially credit card debts, the higher interest rate debts. We want to be quite prudent right now, be conservative, have safety be a watchword for you. And at the same time, let's start looking ahead. The markets are a forward-looking indicator. So we want to make sure that we're getting ready for a possibility of the next bull market ahead. And what do you think that could look like? I'm really excited. Aren't you? I'm really quite excited to really do some research now so that we could power forward and get ready for the next bull market cycle ahead. It's always coming. There's no question that everything goes in one direction forever. So the possibility of us getting ready in advance is what I'm getting ready to teach. And that means AI. I do believe that the high technology will be the next boom, and we might be able to look at a recovery of the business cycle in such a way that we have never experienced before in the past, such that our future GDP by 2026, it has been stated by many analysts, we could be in for a surprise on the upside. Why? That would be because of the growth of new technologies, including AI. And that is what we're going to be moving into in my classes and in my educational courses to help teach what is in the future. What's the possibility for AI in the future? So I'm inviting all of you right now, get on board with me, because I'm going to be moving into all about AI. This is an AI generated image again, as we have multi-generations of women getting on board to create a multi-generational legacy of wealth, because we're going to be learning now about AI. And so I would like to invite each one of you, if you are interested in learning about AI and how to invest in AI, I invite you to go to my website, lynnekitchen.com. And right on the very top right, you will find a Join Now button. Just click that button and it will take you to the page that will help you to get on board to the Wealth Builders Express, which is the name of my monthly membership course, which will help you to learn all about AI. I'm so excited to invite you to the month of May. We're going to be learning all about AI, how it impacts your life, how it is impacting the business cycle, how it is impacting the earnings of company, and what companies are the leaders in AI, and what other companies are the new up and coming names of companies that you need to be knowing now on what could actually be amazing investment opportunities for you going forward. Are you excited about that? Would you love that? Do you want to learn about that? I do believe that if you want to learn about AI, this is the place to come. For the next 4 weeks, I'm going to be teaching all about AI and how to invest in AI. And if you're interested, make sure that you come on board. Go to lynnekitchen.com, click join here. That will take you to the page that you can sign up. And we're going to have not only a lot of fun, but what if we can get ourselves set up for the next bull market phase that I believe will be underpinned by the potential of a brand new industry group coming into fruition that will help rise all boats. So with that, I say thank you for being with me today. Join me each beginning of the month when I will deliver my monthly market overview. And let's be taking a look at making sure that you understand the new terminology of the markets right now. It's sticky inflation. It's been sticky and icky. But what if it's just a blip on the horizon and we actually move forward to some very, very important wealth building opportunities ahead? If you believe the same as I do, get on board, join me. Let's have some fun. Thanks, everyone. Bye for now.